Once you've talked about the different parties involved in transactions, that's where the partner might go, okay, you mentioned buyers. What are the different types of buyers? You could say, well, trade buyers or other companies. So it might be a competitor wanting to buy us for all those reasons, like economies of scale and complementary resources and that kind of stuff. Or you might have a private equity firm looking to buy. And at that stage, they might go, okay, so what is a private equity firm? I thought I'd briefly cover what private equity means. So private equity firms are investment firms that invest in businesses that have high growth potential and are not publicly listed. Although sometimes a private equity firm will invest in a public company with the intention of then making that company private so that they're no longer listed on a public stock exchange. Now, private equity firms will usually pull money from loads of external investors into what is known as a fund. So it's not using its own money, it's going out into the market and saying to investors, look, here's our track record of making great investments. These companies have all grown and been sold for a profit. We've given great returns to our investors. Why don't you give us some of your money and let us invest it for you? So they create a fund and then they use that money in the fund, usually alongside debt as well, borrowed from a lender, to finance their acquisitions of or investment into a range of businesses. And they'll usually buy either entire businesses or a pretty big stake. The businesses they buy tend to be quite large businesses, established businesses that are either underperforming, maybe they've got inefficiencies or something like that, or undervalued. When deciding which companies to invest in, private equity firms might look at, say, 100 businesses. They might then consider 10 of the businesses in more detail and start doing some due diligence into those businesses, maybe commencing early negotiations, and then end up purchasing only 3 or 4. So it can be a long process, raising that money to invest in businesses, deciding which businesses to invest in, and then they complete the acquisition. Now, once they've completed an acquisition or a kind of large stake investment, private equity firm will then work with that business and its management team to try to increase the value of the business over a period that lasts maybe 3 to 7 years. At that point, they'll then ideally sell that business and make a big profit. Some of the strategies private equity firms tend to use to increase the value of businesses include improving operational efficiencies, cutting costs, improving synergies and economies of scale, driving greater revenue, divesting, so selling or shutting down non-core assets or less profitable elements of the business, improving discipline around capital and cash flow. And sometimes they'll buy a business and then they'll go out and buy a load of smaller businesses and add those smaller businesses to the original business they bought to create this kind of larger, more powerful business that can then be sold for a much greater profit. Because that combined business is worth more than all the individual businesses that were brought together. And that's known as pursuing bolt-on transactions, or that's what it can be referred to in practice. So that's kind of how private equity works. Then the person interviewing might say, okay, so what's the difference between private equity and venture capital? And that could be a difficult question because on the face of it, venture capital firms and private equity firms seem to do a very similar thing. I mean, like private equity firms, venture capital firms are investment firms that invest in businesses with high growth potential. They also raise funds from external investors. But the main differences are they usually focus on much earlier stage businesses than private equity firms. Maybe startups that have shown good traction and started to make some revenue and look like they could really explode. That's where a venture capital firm might get involved. And whereas for a private equity firm, that business might be way too small at that point. Venture capital firms also tend to acquire much smaller stakes in target businesses and invest much smaller amounts of money. They might buy 5% of a business, but they might buy 5% of 20 other businesses. And they hope that if 1 or 2 of those businesses explode and become unicorns and then worth billions, that's fine. It can afford to lose its investment on all those other businesses that fail. So it tends to be a bit more risky in that sense. Venture capital firms also tend to contribute expertise, but again, it's the kind of expertise that earlier stage businesses might need. So that could be introductions to other investors, potential collaborators, and all sorts of other kind of assets and relationships that might benefit those businesses.